Hi, sorry about that. Okay, ladies and gentlemen, thank you very much for attending this afternoon's webinar. I think we just had a little technical glitch there, but hopefully you can all see me and hear me now. This webinar today will be discussing just really the basics of support and resistance. We'll be going through what Fibonacci is. I know a lot of these indicators that people sort of come across, but sort of rarely know how to use, and just really when to use them and the correct way to use these things. So hopefully I'll be sort of, going through some of the basics in that. What I'll do is just first things, just a bit about ourselves really. Yeah, just a bit about ourselves really. I mean, obviously 2A markets, and we've been running for the last, since 2003 now, and we've got fairly few relationships with different brokers. What we do is we generally customize what a client really requires, in the sense that the type of trading he or she would like to do, and from that we can then introduce that person to a different sort of broker, or the different brokers. Obviously there's a wealth of brokers out there that you can certainly look at, but the ones we've developed relationships with, we find we work very closely and well with, and they can certainly provide a really good service for our clients. So if I just move on to my next. As mentioned, I mean, most of the brokers we deal with, we certainly look for ease of use in the sense of the platforms they can offer. Obviously, spreads is a subject that's very important for most of us. Tight spreads. ETX is one of the brokers we're currently with at the minute, and we've got a very good offer with them at the minute, which we'll be discussing a bit later on. And I think with 2A markets, what we're trying to do is just to provide a bit more customer service rather than a trading desk at the end of the phone. We can certainly take our time with individuals. If you need a run through the platform, if you need help regards any aspect of your trading, that's what this is all about. So let's get cracking really with the main topic today. So support and resistance. Right. Well, so many people come to me and say, what's the most important indicator out there? What do you like? What you look at? I mean, I've been doing this since 2003, and I'd say support and resistance is one thing that's very, very important. And if you talk about support and resistance, they're very much like a floor and a ceiling, while the main price is really located between them. And the main objective here is to help us knowing the price trends and which way the chart patterns are turning, and determining whether the trend is likely to continue or reverse. Support and resistance exist really because, like the markets, traders have memories, and these markets have a funny habit of really going back and testing certain levels, whether it's a currency or a stock or an index. They tend to repeat actions always which took in the past. And I mean, us as human beings, whether you've got a good memory or not, the market certainly does have a good memory, and whether you've hit a near-term top, just basically it's just one of these things that we have to be precarious of. If we look at this this first graph, hopefully we can all see us here. The red line here indicates resistance, top, the ceiling if you like, and the blue line indicates support, which is obviously the bottom of a channel. Let's just talk about the support first. The support here is a price level where buyers' actions is strong enough to interfere or reverse a downtrend. Buyers can overcome sellers, and it can be said when a downturn hits support zone, it bounces and makes a pause or a reversal. This depends on the support strength, obviously. So support can be drawn by a horizontal line like we have here, or even a slight at an angle. But I think it's important that any support or resistance is connected by a few price touches. Support obviously helps traders to decide when to buy. So if we can look here, we've come down, we've hit an area of importance, we've gone back, we've hit it again. It repeats itself again the third time, and you know what? this is not rocket science. It generally, whether it's hitting the top or the bottom, the price generally comes back and it has a problem, especially bar term. If you're looking at daily charts and 4-hour charts, support is very, very strong. That support, if we look at the resistance, it's just literally an inverse of what a support is. It's a price level where the seller's action is strong this time, and obviously it's enough to infer as a reverse in an uptrend. So sellers overcome buyers, so vice versa, where there's on the support side, where the buyers are overcome sellers. Here the sellers are taking grip of things, and again it can be said support, the resistance zone will go down and make a pause and reverse, and again it depends on the strength of that particular support and reverse. So it's hit it twice and the third time it's broken through. Minor support causes trends to pause, while major support causes support or resistance to reverse. And when I talk about minor and major reverses, when you're talking about minor support being broken or major support being broken, what we talk about there is the time frame. So for example, if you're looking at support and resistance within an hour or half an hour chart, or even a 4-hour chart, we could generally, maybe not a 4-hour, maybe within the hour sort of chart, we could call that sort of a minor support and resistance or a minor break. But if you're talking about daily, weekly and monthly charts, they're certainly major areas of concern or areas of support and resistance you need to be aware of. Right, obviously the all-important how to draw support and resistance, and I've seen some charts that people have drawn in the past, and they're actually very, very simple. It's as I think I mentioned earlier, it's better to draw support and resistance line by horizontal line. So if you can get all charts, including our very own ETX platform, you can draw horizontal lines through, and through lower and upper edges of congestion areas are the main areas you need to be looking at. If you trying to phase out spikes, little spikes like that, you're always going to get news events or little dips in the market, but areas of congestion whereby, what I mean by that is if the price has gone there a couple of times and have found it difficult to penetrate, so there a couple of times, quite simply drawing simple horizontal lines. And obviously this is a weekly chart here, so these are major resistance and support areas. And what I really do advise people to do when drawing support and resistance, and whether you're an experienced trader or someone who's fairly new to it, bring up a daily chart or a weekly chart, whatever instrument you like, whether it's a Dow Jones or whether it's a currency, and just have a go at it. Go in, just a plain candlestick chart. Don't put anything else, forget the MACDs or everything else, and simply draw thick lines where you can see price action is congested. And what you do with that is print it out and put that in front of you. So you've got a daily and a weekly chart. Like I said before, us as human beings, some of us have got fantastic memories. If you're like me, the memory isn't as good, so I can't remember what I did, where the price was maybe 6 months ago, let alone last week. Have something printed out so we know where important areas the Dow has been to. Just recently, if you look at the Dow, we've hit all-time highs. We got to that support, we got to that level of resistance, we came back down, we've come back up again, and we hit that resistance again. I mean, that's only happened a few weeks ago, but I wouldn't have remembered if that was last year or a few months ago. So, print your long-term charts out with support and resistance. It's a very handy tip, and I've been certainly doing that for the last 13 years since I've been involved in the markets. Right, okay, let's move on. So some of the factors that affect support and resistance strength, really, I've told you how to draw these lines and what they are, and really it's support and resistance length we're talking about here. The longer time or the number of hits a support or resistance it gets, the stronger it is. For example, on a weak support or resistance creates a minor support resistance. A month support or resistance provides an intermediate level of support or resistance, while a 1-year range will become a major or a strong support of resistance. So as mentioned before, you should keep in mind what time frame you're looking at. Daily charts, monthly charts, obviously they're going to be major support areas. 4-hour charts, again, I'd say fairly major. But then as you go down the time frames, the period times within the hour, half hour, 15 minutes, less prevalent the support and resistance areas are, and obviously more often than not these areas can be penetrated. So just as with most support and resistance, even if you're talking about daily, the more times these areas get hit, and obviously the more time goes by where the area hasn't been hit, that support will become weaker and weaker. Very much like your own memory, it fades. So bear that in mind as well. So again, the height of the resistance. So as we're looking here, if we talk about the height of the resistance, prices hitting, the wider the support resistance area here, if you're looking, the stronger it is and the wider it is. Congestion zones between the support and resistance act like a higher barrier. So if you're thinking about it, it serves as a stronger level. The strength of this zone can be calculated by a percentage of the current market value. So that's one thing. If you talk about how long between the area's been hit, if it's sufficient amount of times it's hit, and the length of time it's taken for it to hit that same area, it all goes into how strong that particular resistance is, or how strong that support is. So this is a fairly decent sort of chart, just illustrates that fact. The final one is trading volume. If you get sort of days like American holidays or UK bank holidays, support and resistance areas invariably can be broken very easily, and the reason for that is because of lack of volume and market depth. In a fully sort of in a fully high volume market, more often than not, these areas will be respected because there's people behind the screens here, and like you, like me, there's banks out there, market makers that know where support and resistance areas are. And obviously you've heard the old adage whereby taking out stops from your market maker. All these guys, they know where areas of support and resistance are. If you start using support and resistance yourself, you yourself will see the benefits of making sure that you're one step ahead of a market maker, or one step ahead of what the market is potentially looking to do. That sort of takes me on nicely to my next topic, which is how do you trade it really? How do I trade support and resistance between these lines? So we've covered a bit of the basics. And really, to apply these sort of basics is pretty simple. I've divided support and resistance levels into sort of two simple ideas. So bounce and break. So here's a sort of a bounce. As the name suggests, it's one method of trading support. So as resistance levels, trading support and resistance levels is right after the bounce. So many retail traders make the error of setting their stop losses directly on the support. So if you think about it here, there's a support area, again the support area. I see so many retail traders just putting their stop loss smack bang on the line. So if you have done lines of support and resistance, please don't make the mistake of putting stop losses smack bang on the line. It's very important that you give sufficient amount of price action or price gap in between where that particular resistance area is or support area. I see it so many times where analysts are saying the market's moving up to take out stops, or the market's moving down to take out some of these limits that we've got in. And the reason for that is because they know the retail punter out there, they've got their stops in, and most probably they've got their stops in right on their support or the resistance area of these markets. So, to avoid yourself being stopped out and then the market going back up again, have your stop loss below an area of support. It's a perfect trade. I mean, I'm hoping most of you, when you do put your stop loss, put it for a reason, that you don't just pluck a figure out of the air whereby I'll say, oh, I think I'll put my stop 20 or 30 points away. I mean, it's got to have an inherent reason why you've put that stop loss before, just below that support. And, you know, if you have put a stop loss below there, a perfect entry point would be just above the support. So if you've got an order to buy here, it's a perfect area to buy. So if it does go against you, you know, you'll be stopped off. If the market, if the support is broken, it's fine. You know, you'll be stopped out and you'll be safe. But, you know, more often than not, you won't be stopped out. It'll be messing around this line and it will reverse, and hopefully you'll be making some good profit. Likewise on a trend line, it works exactly the same way if you're working as from trend lines as if you're working on horizontal lines. If you've got a horizontal a trend line here, a stop loss just above, below the resistance, or below if you're working towards support. So that's one area to think about. The other thing is, obviously, I'm sure you've probably heard about this as well, when the price actually breaks through support and it reverses back up. So many times I've seen people, you know, again, get stopped out. And when the price reverses back up, all the price is doing is merely pulling back and testing that support again. If you think back to my earlier slide, when support becomes resistance, or indeed when the resistance becomes support, this is what we mean by this. When support becomes resistance, so we've broken down, we've gone back up, it's now acting as an area of resistance. And what it does is you can safely put your stop loss just back above the area it's broken and put an entry point just below it, and you can then sell that market and hopefully make yourself some good cash there. So that's the bounce. We can move towards the break, and obviously it's pretty much self-explanatory. The higher the volume, let's just move this, sorry. This is the break. So obviously in a perfect world, support and resistance levels will hold forever, and, you know, we'd all make hundreds and thousands of pounds, and, you know, everything will respect a price area. And of course, as you know, it's not like that. Support and resistance does get broken, should I say? And, you know, obviously, the higher the time frame which a support or resistance has been broken, the more prevalent and the more market turning action that will really come in. Whenever a price goes straight through support or resistance, there's two ways of trading this break. One is obviously really just jumping on board. It's a bit of a, many would say it's a bit of a risky way of trading, but it's also a very profitable way of trading this type of strategy, because, you know, you've seen a major line of support or resistance been broken. You can have an entry point, you know, 10, 15 points below that support line, and you can basically then ride a ball above that trade and let that run down, because once support is broken, you'll tend to see a market come down at least 20, 30, if not more, 50 points down. So, you know, it's a risky way of doing it, and the reason why I said it's risky is because if you look at the second slide here, support can break. Again, it can pull back up. If you think back just a couple of weeks ago, those of you guys who like to trade the indexes, the Dow, perfect example. If you saw the Dow come down, I think it was just the middle of April, we went down all the way down to 16,000 on the Dow. So much of the retail market started to sell the Dow, thinking, that's it, we've had our bull market, we're pulling down. And what happened? Two, three weeks later, or even a week later, the Dow has rebounded up more than 600 points. So the Dow came down, if you thought, and so many people here started to sell the market thinking it's going down, and in fact the Dow's gone all the way back up. Those of you who trade the Dow will know exactly what I'm talking about, and unfortunately it's trapped so many people who sold the market down here. So when I talk about risk, this is the risk you're taking. But those of you who do have patience, you can actually wait for the price, because ultimately what the market's done here is told you that I've broken support. In a game of poker, when the market shows you its hand, it's told you, you know what, I've broken support. It doesn't mean I'm going to go down. What more times what happens, it reverses back up and it tries to find a bit of resistance. Sometimes that resistance will be at the top where we've just come from, or sometimes it could be half of that where we've just come from. My next topic, Fibonacci, will be sort of covering that a bit more. So these two topics are very much intertwined, but a safer way would be, you know, if we do break support and resistance, just wait, just be patient, because it will find a bit of support somewhere. It will come back up, and that little bounce up won't be as strong as any other bounce, because it will come back up, and that will be a perfect time for you to go in and start selling again. And more often than not, it will come straight back down again, and it will be a lovely trade for you to get onto short. Oh, that was support and resistance. So hopefully that's sort of giving you the basics of support and resistance and giving you a few sort of techniques on how to trade these sort of markets when looking at support and resistance. So it's sort of actually that last point neatly sort of takes me on to Fibonacci, because the two topics are very much similar in the way what they look at and how you can use one with the other. So Fibonacci. Some of you, I had lots of questions again about Fibonacci. What does it mean? How do I use it? Let's go back right to the start on what Fibonacci is. So Fibonacci retracement levels are extremely popular with investors because of their simplicity and consistency. So Fibonacci retracement levels are calculated based on Fibonacci sequence. Don't be put off by all these numbers here. It's pretty straightforward. Fibonacci, just to let you know, was discovered by a gentleman called Leonardo Fibonacci, so no surprises to why it's called Fibonacci now. But this indicator uses a series of mathematical ratios discovered by Mr. Fibonacci, and they're basically based on the constant relationship between the sequence of numbers. And this sequence of numbers is called the Fibonacci summation series. So if we look at the series of numbers here, and apologies for those of you who obviously know what Fibonacci is, but I think it's important for you to understand what these numbers are. It's the case of the sequence here. So 1 plus 1 is 2, 1 plus 2 is 3, 2 plus 3 is 5. You get the idea. And this goes all the way to infinity. So what's interesting about these numbers is that the constant relationship between them. So the sum of any two consecutive numbers equals the next higher number, and the ratio between any number and the next higher number approaches 0.1618. After the first four calculations, the ratio between any number and the next lower number is approximately 1.618, and this is the inverse of 0.61. So it's not a maths lesson, but it's just giving you an idea of why these numbers are important. So, and these relationships, and this 0.61 is familiar retracement levels we've come to know and use. So if I move on to the next slide, some of these percentages most of you will have come across when you're using your retracement level. So the Fib ratios as a percentage are what we are interested in as traders. So if we look at these ratios, so 23.1, this is the shallowest of retracements. It's very strong trending markets. This price is typically a quick bounce into this area of the ratio. So when a market explodes up and it starts popping back down again, potentially 23% is the first port of call when a market will find a bit of support or resistance. 38.2, this is the first line of defense when the current market is breaking. And you know what, if we're in a bull market and we started to test the 38% retracement level, this is the first area where we started to erode the main line of trend. So 38%, that's what that means. 50% is a neutral point of any retracement, but it is a very critical tipping point. So for example, we've fallen down, we've risen up on the Dow and we've come all the way back down, and if we've gone past the 50% of that whole move, potentially this is the bull market or the bear market, however you want to put it, is under threat of being turned on its head. So the 50%, that's what the crux of that is. 61.8, this typically signals the breakdown of the end. So if that 50% is broken and it carries on down, we can safely say that that bull market has come to an end, and we've changed tact. We're going back down again. 100% move, again, if it's just completely retraced that 100% move, it means that particular break meant nothing. And this was a perfect example on the Dow a few weeks ago. The Dow a few weeks ago retraced almost all its level. I want to see if I can bring that up for you guys. Just bear with me. So I'm just going to get this chart up, see if I can actually explain what I'm sort of talking about here. Where's the Dow? Just bear with me. Hopefully you guys can see that fine, okay. Right, here's the Dow chart. Just make that slightly bigger. We'll put the 4-hour candle in. Right, if we look at this Dow chart here, hang on, just so if we look at this Dow chart here, this is the rise we had, well, just a few weeks ago. We hit a near-term high, and it came thrashing down, if you remember, only a few weeks ago. And what it's done is basically it's hit that support level on the 100%. So it's broken through all these lines of 23, 38, 50%. It's come all the way back down, and it's reversed. It's a great way of just explaining and describing how support and resistance and also Fibonacci can work. So it's basically, if this 100% level, if you can see where, if you have a look at this line of support here, we have plenty of support and resistance down here, here, and there's 100%. It's come all the way back here, and it's reversed itself. Whether this comes all the way back is anyone's business, but at the minute we're testing the 50%. So we can't say this downward, when it started to crash down, we can't say that this is a valid break of the uptrend yet, because we're at the 50%. We're at a critical juncture here. If we start moving more and more up, we can stay, nah, it's just going to carry on going back up. But if we start reversing again, we've made a higher low. We can potentially go down further. So hopefully that sort of explains what I was sort of talking about there. But if it doesn't, you know, I can try to go through that again individually sometime. I think I've pointed these ones out again. So when to use these, this is just three of the main retracement levels, 23, so 38, 61, and 50, as mentioned. And you know, when you're going to use these, really, the first indication of a consolidation towards the Fibonacci retracement level was drawing a trend. That when there is a slowdown in momentum or price action starts going sideways. So this situation is an opportunity to enter the market. So as I showed you with the Dow, if I can show that Dow again, I don't know where that chart's gone, unfortunately, but if we're in an upward trend and it started to slow down, that's the time to use a Fibonacci to see where potentially we would be coming for that break. Again, just to show you here, here's a 50% Fibonacci. This is, in fact, this is the Russell 2000. As you can see, it's hit the Fibonacci level of 50% multiple times. Once, twice, 3 times it's hit the 50% before it actually started to reverse going back up. Again, these are profitable trades. You could be having your stop loss below this Fibonacci level. It's an area of support, you can call it, and you can have your entry point just above it. So obviously you're not going to have it at the first point of call, but the second time it hits, have your stop loss below it, and to buy just above it, beautiful buy there. Again, it's come down there. if it comes back down there again, you should be alerted as a trader. Either this is going to break through it, or it's going to do exactly what it's done the last 2 times. Again, have your stop loss just below it and an entry point just above it. You know, if this carries on going above, it'll be a lovely trade. This is what we call, ladies and gentlemen, planned trading, safe trading. And rather than you just going in willy-nilly, buying and selling, thinking the market's too high or thinking the market's too low, think about why you should buy this market. Think about why you should sell it. Is it at a critical juncture? Is it at a specific Fibonacci level? Is it at a support or a resistance area? Why am I to put a stop loss at that level? Why should I buy at that level? Trading is about planning. The more planning you put into your trading, the more successful you'll be. This is why so many retail traders come in, they'll throw money at it, and fortunately, invariably, just lose it all because they're not planning and not thinking about where they'll actually buy or why they'll put that stop loss in. So brokers, I mean, I'm a broker myself. I was working on the market making desk. We know where these levels are. We know where the high of the Dow is or where the Dow has come back and retested, because we know most of the market will have their stop loss on there. And we'll go and fish out these stop losses until everyone's gone and the market invariably will carry on going back up. So, you know, start thinking about and start planning with your trading, because that's what's going to keep you in the market. It's going to keep you in the game. Stop losses, of course, very important, but have your stop loss for a reason and put it at a level where you know it'll help you. Having a stop loss below here would have helped you, but an entry point here, of course, you know, would have been profitable. I think this is my final slide on Fibonacci, but again, it just goes to highlight what support and resistance is, and it goes to highlight how Fibonacci is, and you know how to draw these levels. What I generally do is, this is an uptrend. If you think this is the start of an uptrend, I'll start the Fibonacci from the top. When the market started to move up, I'll take the highest peak where I feel the market's had a bit of problem going down, and I'll basically draw all the way back down to the low point, and from that I can get my averages, my retracement fibs here for 23, 38 and 50. If you can see this here, you can see the 30, go back to that one, apologies, the 38%.2. I mean, as I mentioned before in my presentation, the 23% has acted as just a first protocol barrier. The market's exploded up. The first line it's come down to is the 23. Once, twice, 3 times it's come down there, and finally on the 3rd time it's broken. And when it did break, it's come all the way back down to the 32%. And that ultimately held. That's held, and you could have had a stop loss below the 32% and a buy above there, and ultimately it's come all the way back up. And even when it has gone back up, look where it's come back down to, the 23%. And from there, it's just continued its upward trend. So it's areas like this where the support and resistance and Fibonacci can help you actually make money on these markets, and especially in these sideward ranging markets. I mean, for those of you who are trading currencies at the minute, most of you will be, currencies are very tightly wound up at the minute. The sideward ranging markets, the ranges are very tight, but you can use Fibonacci, you can use support and resistance to make small trades here and safe trades. You know, I mean, if a market has moved up sporadically or if it's crashed down, don't just jump on board it. Have a look at why it's crashed down and potentially where it could come back up to come back down again. Because obviously, if this market's gone up, I can either try to jump on it and hope for the best, or I can actually wait for it to come back down somewhere. Rather than trying to guess it's going back up, why don't the safer trade would be to wait for it to come back down, and when it's actually, you know, found a bit of support somewhere, start buying it. Again, wait for it to come back down, start for a bit of support, buy it again. Again, if it comes back down again, if it hits my stop, don't worry about it, it will come back down. That's my next target to buy, 38%. And if I buy again, I know I can make money. Again, if it comes back down, these are simple strategies and simple areas of entry you guys can go in and make money. And with that, I'll conclude my Fibonacci webinar. Hopefully that sort of helped you guys in the sense that it's given you a bit of an inkling on what support and resistance is and what Fibonacci is all about. And hopefully, you know, going forward, two-way markets will help you with further webinars going forward. We'll be looking at MACDs, RSIs, super indicators. There's plenty of indicators out there, but it's getting the best out of these indicators that will seriously help you in getting the most out of trading. Before I go, I just want to touch upon the broker that we recommend, which is ETX Capital. I think I may have shown the chart earlier on, but here's the trading platform. I'll try to squeeze that in for you so you guys can see. ETX Capital, we've got a relationship with these guys whereby they can provide you guys with spreads on the euro as low as 0.7. We've got 1 point spread on the Dow, on the FTSE and the DAX. We've got one-click execution. And what I really like about ETX is the ability to be flexible on your trading. Hey, listen, I might trade at a higher stake because I've been in the market for 13, 14 years. But for those of you who are starting out, ETX allows you to trade all the way down to 50p a point. It's important for you to feel yourselves in the market rather than jumping in heavily. So whether you're trading the Dow or the FTSE or a currency, you can trade all the way down to 50p. And on certain instruments like the gold, you can trade down to 10p a point. Again, it's got award-winning apps. You can trade on your iPhone and Android, and obviously you can also trade from charts. Let me just quickly show you here. Most of you guys, to show you, here's a charting facility. You can actually trade from the chart. So you can, in fact, have your support and resistance areas already lined up and buy by looking at the charts here. So a very, very good feature there on this platform. And the offer we're currently running on this is an iPad, and obviously for those of you who have actually just come on board the webinar today, what we are offering is, I mean, I think the offer is we've only got a couple of weeks left. Where it's expiring on the 31st of May. I'll be more than happy to post off an iPad for any of you guys who can trade up to a certain amount of trading volume. Currently that stands at 1 month. So those of you guys can trade FTSE, any of the indices or commodities or currencies. We can, if you can trade up to £800 a point. I might hear most of you saying that's far too much for me to do in a month. What I can do for you is I can extend that over a couple of months, even a little bit more if need be. I'm very flexible. If you're nice to me, I can certainly give you a bit more flexibility on that. But you know what? Ultimately, once you've done your stake, I'll be more than happy to post over an iPad for you guys. It's a nice little incentive for you, and you know, more than the iPad, I think the platform would certainly suit whether you're a new to trading or you're someone who's actually more advanced. Just one other thing, the platform that I've just shown is the ETX Pro version. There is a light version of this platform which is more suitable to clients who are really just coming into the market. So if you're new into the market and you think this platform is a bit too busy for you, I can set you up with a lighter version whereby it's a lot more basic. And if you need a bit more help, I'm more than happy to run through the platform with you. Here are my details, my phone, email and Skype. Feel free to get in touch. And you know, any of the topics I've covered today, if you've got any questions, feel free to email me or drop me a Skype or a call. I'll be happy to go over it again. But thanks you for attending, and hopefully you found that enjoyable and informative. Thank you very much. Bye-bye.